Welcome to the Deep Dive. We're here to give you the essential analysis, cutting through the noise on the market narratives that really matter. We strip away the jargon, look at the strategic shifts. Today, we are locking on to Seer Inc., ticker SEER. They're the proteomics tech company. We're digging into their second quarter 2025 results and the conference call they held back on August 6th. Now, if you follow the life science tool space, you'll know Q2 wasn't just a routine update. It felt like a pretty significant pivot, didn't it? Really focusing hard on execution, scale, high throughput stuff. Our mission here is to figure out how this shift might, immediately validate their technology and strategy.
Yeah, and it's important to look past just the immediate stock tick.
Yeah.
Especially with Seer. I mean, the initial market reaction was a bit quiet, right? Sometimes that happens when investors are trying to process a complex strategic shift. But then you saw that rally, which signaled the market pretty quickly figured out the operational progress was maybe more important than any short-term financial bucks.
Okay, so let's get that snapshot first, the headline numbers.
Right. So Seer delivered a solid beat, both top and bottom lines for Q2. Revenue came in at $4.1 million. That was comfortably ahead of the consensus, which was around $3.75 million. And that's 32% growth year over year. Pretty strong.
32%.
It's okay.
And on the earnings side, they seem to have managed costs well.
They did, yeah. GAAP EPS was a loss of 33 cents. That beat the consensus estimate, which was looking for a loss of 37 cents. So, mathematically, a clean beat across the board. But like you said, the real meat of the story is in those operational changes, the cost control, the product rollout. That's why I think the stock moved up so sharply the day after the call.
Yep.
Investors keyed into that.
Okay, let's unpack that financial discipline then, because look, for a company like Seer, not yet cash flow positive growth stage, managing expenses is just as crucial as growing revenue, wouldn't you say?
Critical.
So let's start with gross margins. They landed at 52%, giving them $2.1 million in gross profit. Management did mention some year-over-year pressure, though. What was causing that?
Yeah, they were pretty clear on that. It basically came down to higher costs for installing instruments and training customers, which, is kind of the short-term price you pay for getting those instruments successfully placed in labs.
A cost of growth, essentially.
Exactly. But what helped offset that was the mix. They got stronger contributions from consumables and service revenue. That suggests the model's working, right? Mm-hmm. Get the box in the door, and then you get that recurring revenue stream from consumables, which inherently carries higher margins.
Makes sense. But the real eye-opener on the financials for me was OpEx. Operating expenses down 21% year over year. That's huge. Came in at $22.6 million. They pointed to lower stock-based comp, SBC, as the main driver. So the question for us and for you listening, is this sustainable? Is it real operational leverage or more of a, one-time accounting thing from old grants rolling off?
That's exactly the right question to ask. Because if it was just like a big batch of stock options vesting and finishing, you'd worry it wouldn't last. But management's commentary suggested a very deliberate effort, rationalizing R&D spend, G&A, basically shifting resources to back the commercial launch of that new high-throughput platform.
So while, the SBC timing definitely helped the reported number, the overall message was about building structural efficiency, not just getting lucky with accounting. They're clearly watching the burn rate very closely.
Okay, and that OpEx control helps them protect that, fortress balance sheet they've got. They ended Q2 with a massive $263.3 million in cash, equivalents, and investments. That's a long runway.
It's really the defining financial feature right now, isn't it? A huge cash cushion. And management explicitly said they think that capital is enough to get them to cash flow break even.
Wow.
Yeah. I mean, for a clinical stage tech company, that's an enormous de-risking statement. Takes the immediate pressure off needing to raise more money and dilute shareholders, which is frankly priceless in this kind of market environment. And they're putting their money where their mouth is, too, not just talking. They kept buying back shares, used about $20 million of that $25 million authorization just in Q2.
Right. And that buyback led to a 13% net reduction in the total shares outstanding. Think about that signal. Management's got over $250 million in cash. They think it's enough to reach profitability, and they're buying back stock hand over fist. They're practically shouting that they think the stock is cheap compared to the platform's intrinsic value. Huge conviction signal.
Okay, so the financials paint a picture of, let's say, disciplined confidence. But all that cash management doesn't mean much if the core product strategy isn't delivering, right? If they can't get that scalable adoption they've been talking about. What was the real strategic news here, the shift to scaling up proteomics?
Yeah, the whole call really revolved around scale. The CEO highlighted two really key launches. the Proteograph ONE high-throughput assay, and the SP200 automation instrument. These are crucial because they fundamentally tackle the economic and technical hurdles that have historically limited large-scale proteomics work.
Okay, for listeners maybe not super deep in proteomics, can you quickly break down what these new pieces actually do? Why are they important?
Sure. So Seer's big claim to fame is that their platform is unbiased. It lets researchers look across the entire proteome to discover new biomarkers rather than just confirming ones they already suspected.
Discovery versus validation.
Exactly. But discovery needs data. Lots and lots of data. The Proteograph ONE is basically the engine that lets scientists quickly prepare potentially thousands of samples before they go on to the mass spectrometer for analysis. And the SP200 just automates that whole sample prep process, makes it faster, more consistent.
Got it. Automation and efficiency driving scale.
That's the core of it. And that automation, that efficiency, is what changes the economics. The Proteograph ONE, combined with the automation, more than doubled the sample throughput. It's talking over 1,000 samples a week now. And it cut the prep time by about 30%. That's huge because it means researchers can realistically move from these small, maybe few hundred sample studies, which often don't give clear answers to properly powered large cohort studies, population scale.
And we're seeing proof of that already, right? Actual large contracts. This feels like the real world validation people were waiting for.
Precisely. The big one they announced is this landmark study with Korea University. 20,000 samples, population scale.
20,000. That's massive for deep plasma proteomics.
It really is. And the goal is specific. Find AI-driven biomarkers for cancer diagnostics. This isn't some small pilot project. This study alone is a huge validation that the Seer platform can actually handle the kind of scale biobanks and big clinical research groups need. And it comes right after they announced that 10,000 sample study with Discovery Life Sciences. So there's clear momentum building.
And that scale, that throughput, ties directly back to the business model, right? Shifting from relying on selling expensive machines, the CapEx, to getting that steady, recurring consumables revenue.
That's the so what. Absolutely. Higher throughput means a lower cost per sample. Simple as that. If you can analyze a sample way cheaper than older methods, you suddenly unlock studies that were just too expensive before. And that's how you build that long-term, sticky consumables revenue base.
Okay, let's talk about how they're getting customers on board. The Seer Technology Access Center, STAC, that's their sort of service lab model. How's that working as a funnel to sell instruments?
The numbers look really good there. Over half, more than 50% of the instruments they shipped in Q2 went to customers who had already used STAC services.
That's a strong conversion rate.
It really is. It validates that service to sales approach really well. It's like a super effective try before you buy program. And what's neat is they apparently expanded STAC's capacity without spending more capital, just by implementing the new, faster Proteograph ONE assay internally. More efficient use of assets.
That conversion rate is impressive, definitely. But is there any risk there? Like if they convert service customers to instrument buyers too quickly, do they risk eating into their own service revenue? Or is the instrument sale with the consumables that follow just so much more valuable?
That's a good point, a subtle one. But I think given the typical margins, services usually run at lower margins compared to consumables. The company always wants the instrument sale. The goal isn't really to be a big service provider long term. It's to build that installed base of instruments. Every machine they place is basically an annuity, guaranteeing years of high-margin consumables revenue. That creates a much more predictable and scalable business.
Right. Makes sense. Okay, shifting gears slightly, partnerships. They have that co-marketing deal with Thermo Fisher, specifically around Thermo's Orbitrap Astral Mass Spec. How's that progressing?
It's moving along, maybe a bit slower than some hoped initially. Management mentioned they finished important training for Thermo's sales teams in the US and Europe, so the commercial reach is getting stronger. But the actual revenue recognized from the partnership in Q2 was very modest, was the phrase they used.
Okay.
But importantly, they do expect to recognize the first sort of substantial revenue from that collaboration in Q3. So it suggests the joint pipeline is starting to bear fruit, just taking a little time.
Okay, so let's pull this all together for the investor perspective. We've got strong operational execution, exciting product launches. But management still sounded a bit cautious on the macro environment. They stuck to their full-year guidance. But what headwinds did they call out? And what's the plan to navigate them?
Yeah, they did reiterate the full year 2025 revenue guide, $17 million to $18 million. That's about 24% growth at the midpoint. Sticking with that after Q2 is definitely a sign of confidence for the second half. The headwinds they mentioned are probably familiar to anyone following this space. Persistent macro budget pressures, customers facing tight capital budgets especially, and then ongoing uncertainty around government funding in the U.S., particularly NIH budgets. Plus things like tariffs, policy changes adding uncertainty.
Sounds like a tough backdrop to be launching a platform that requires a significant capital outlay, yet they held that guidance.
And this is exactly where that strategic pivot we talked about becomes so important. It directly addresses the challenge. Their core argument now is our shift to high-throughput automation leads to a demonstrably lower cost per sample. And that's designed to directly counter those budget constraints customers are feeling.
So it becomes an efficiency play.
Precisely. When NIH funding is tight, or a pharma company's budget is squeezed, researchers have to prioritize efficiency. If Seer can clearly show their system dramatically lowers the effective cost per analysis, well, then they become the smart financial choice, not just the novel technological one. The whole strategy is aimed at locking in those large, durable consumables contracts, which are much less sensitive to budget cycles than hoping a university approves a big capital purchase for one machine.
Okay. Now, for experienced investors tuning in, maybe thinking about the long-term potential here, we arrive at our segment, This is Not Financial Advice. We like to look at potential disconnects between valuation and strategy, given everything we've just unpacked. My pitch, purely hypothetical, of course, for a long position here hinges on two things converging. First, that aggressive buyback creating a kind of capital floor. Second, the immediate real-world validation from the Proteograph ONE launch acting as the growth catalyst.
Okay, interesting angle. So you're basically seeing a margin of safety combined with a clear growth trigger. Unpack that downside protection part first.
Right, the downside protection feels built in from their capital management. You've got that 13% share count reduction from the buyback already banked. You've got the massive $263 million cash cushion. It signals management thinks the stock is undervalued, and they're actively reducing the float while ensuring they have that runway to break even, like they said. It really limits the perceived risk around liquidity or needing to raise cash anytime soon. It puts a floor under things conceptually.
Okay, I see that. And then how does the operational success, like that huge Korea University study, translate into the upside trigger in your thesis?
That study, the 20,000 samples, that's the proof point. It's a hard, tangible catalyst showing the platform delivers the scale needed to drive consumables now, not in some theoretical future.
It shifts the narrative.
Exactly. It shifts the narrative from Seer being this interesting but maybe unproven, prove-it technology fighting for instrument sales to becoming a scaled adoption story backed by major studies driving predictable revenue. That's the kind of operating leverage story the big institutional investors look for. It changes the key question from does the tech work at scale to how fast can they ramp up consumables usage?
That's a solid thesis. You've got the capital allocation providing a buffer and confidence, and the high-throughput validation removing that major scale uncertainty that often dogs these novel life science platform launches.
So recapping this deep dive, Q2 was really defined by sharp strategic execution. Seer estimates showed impressive cost control and crucially launched that high-throughput tech, which immediately led to these population-scale deals, the kind that just weren't feasible before, economically or technically.
Yep. And that brings us to the sort of ultimate question for anyone watching the broader life science discovery market. Proteomics has a long history, mostly focused on targeted approaches looking for proteins we already know about. The big question for Seer is whether their new, scalable, unbiased approach, the one that's finding, quote, previously unexplored proteomes and novel biomarkers in these big studies, is going to fundamentally capture the lion's share of future large-scale discovery budgets. If they can genuinely displace older platforms and set a new standard for discovery at scale, well, the operating leverage could be immense. That shift from relying on CapEx sales to driving sustained consumables revenue, that's the metric everyone needs to watch closely going forward.
Thank you for joining us for this deep dive into Seer Inc's Q2 results. We hope this analysis gave you the essential context behind the strategic shifts happening right now.